All right. What is up, traders? What's up, tycoons? Super excited for today's video. We are going to be breaking down TLT. As I mentioned in previous videos before, I think TLT ultimately is going to become range bound. And I think that that range could be between 89 and 82, maybe even $80 if it wants to break its previous lows. But one thing we want to look out for here is going to be potentially an inverse head and shoulders forming if we pull back and start to fill these gaps down in blue. You can see we're looking out and being cautious for a potential bear flag here. All right. And rather than getting the breakdown and getting the bear flag to play out, TLT rebounded very nicely here. So that was nice to see. We have our TNX chart here. And after putting in our wave 3 highs, we are starting to head down lower for that wave 4. And, looking to see potentially if we can come down to 4.4 on the 10-year treasury. We'll break down all of those charts in detail, but there's some important stuff I want to go over, especially with the crazy move that we've seen in the S&P 500 and the NASDAQ. Those things have been posting, really tremendous gains, especially, the consecutive gains. I mean, I think the NASDAQ is at like 8 consecutive trading days positive. We'll have to see how things close today, if it can get to 9. Then we also want to go over some earnings per share. Take a look at what Carl Quintanilla said from Bank of America. There's some important seasonality related to AMD and NVIDIA, especially for November. I want to bring to your attention. Then we'll take a look at flows from global investors, CTA positioning, financial conditions. We'll take a look at the soft data as well as the U.S. dashboards for the macro matrix. Bloomberg has some stuff here saying about jobs data. We'll go over that as well. And Bloomberg making a very bold call saying a 52% chance of a recession, right? So basically a coin toss in their opinion. And then we'll look at the gold to copper price to ratio and kind of go over what this could mean for you guys and what this could mean for the markets. We'll also take a look at some leading indicators, all right, and see if those are positive, neutral, or negative. But as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. I started a completely free newsletter for you guys called Investment Intelligence, giving out free trade ideas and free valuable finance content. Okay, this is what the trade ideas look like. We highlight what the idea is, show the chart, and these trades work out very nicely. Okay, a lot of them have worked out very nicely. This is home builders over 2 months ago, highlighting the bearish patterns here. That ended up dropping over 18.5%. This was another one, SWK, highlighting the rising wedge, highlighting where we think the price could come down to. That played out very nice as well. Even just the last two posts, the last two trade ideas, Roblox, we had a cup and handle expecting a move to the upside, played out beautifully. ARM, the most recent trade idea, we talked about the false breakout. Today, it's down big. All right. So sign up for that newsletter if you like free trade ideas and free valuable finance content. If you want access to all of the different trade ideas and to see what strategies I'm using on a day-to-day and week-to-week basis, you can join the Investment Intelligence Discord. Okay, it's less than a cup of coffee a week, and you can sign up using the link in the description below for that as well, to get access to all of the different trade ideas rather than just one or two a week from the newsletter. All right, there's also many other things in there. Right, there's custom scripts that I have, scans. You guys get access to all of the flexible grids that I use to dive underneath the hood of the market. And if you ever feel like you need that one-on-one personal touch, you can book a coaching session, right? I do 1 minute, or I do 1 hour and 30-minute personal sessions, one-on-one sessions. You can book those directly through the Ko-Fi page as well, using the link in the description below too. So that's it. We're going to go ahead and dive into the video now. All right. And what we're looking at here is the weekly rate of change, is this black line right here. And you can see that once we get these really huge spikes, right, and this is very rare. All right. This is what we saw last week. Huge rate of change. We went from oversold basically to essentially overbought within a 1 week time span. And you can see once it gets to these levels, and not only is it very rare, but it's very much a whipsaw, right? And you tend to see, sharp moves to the downside afterwards, after you get these really large moves to the upside. So, you do want to be cautious, right? That's why in the last video, I said, hey, don't buy the top here. From a risk to reward standpoint, it just doesn't make much sense as a trader. Now, I mean, if you're long-term dollar cost averaging, that's something different, but this kind of summarizes, visually and using some data, the whole essence of the last video, don't buy the top. Now, if you look at third quarter earnings per share, it's tracking a 4% beat driven by margins. Sales are tracking a 1% beat. So that's why Carl Quintanilla here is saying that the economy is cooling, but companies have had their earnings recession, have cut costs, right? We saw that they had that earnings recession last year. We saw the massive amounts of layoffs that companies like Facebook were doing, and now they're enjoying margin expansion. We'll have to see if they were actually getting true margin expansion. That's up for debate, but for right now, that's what a lot of the earnings is saying, is that it is driven by margins. This is AMD right here to the right, and this is NVIDIA. And what we're looking at is a monthly seasonal performance in November, and November for AMD and both NVIDIA is their strongest seasonal month out of the year. Not only that, but I've mentioned before how hedge funds fiscal year ends in October. And so what this means is that, if they have stocks that they have massive losses on, what they'll do is they'll sell those in October, in the month of October, just to get those off the books, right? Even if it's at a massive loss, they'll still sell it. And, as soon as November came around, the stock market pretty much went straight up, right? And so that kind of coincides with that seasonality, with the hedge fund seasonality in October, tax loss harvesting. And now we're in November, and November has been a very strong start to the month. These are the best months for the stocks AMD and NVIDIA. So we'll have to pay a close attention to these stocks, see how they perform. It'll be really interesting to see if this aligns again. On average, AMD gets about a 16% gain, and on average, NVIDIA gets about a 9% gain. So it's pretty substantial, right? It's not anything minor. This is the expected moves, basically, for the month. You can screenshot this for the major stocks, okay? And this is as of Monday, okay? So these were the expected moves for 1 month out, for the quarter, 6 months, 1 year. This will be pretty useful, okay? Most of the time, these stocks, they close about 2/3 of the time within their expected moves. Last week was a great example of us closing outside of that expected move, and we actually doubled the expected move, which is also just an extremely rare situation, and was another reason I was telling people, hey, don't chase the top here from a risk to reward standpoint. It just doesn't make much sense. Now, these are flows from global investors into equity funds, and we can see that emerging markets, okay, we're just seeing a lot of money coming out of here right now, and this is still continuing a downtrend here currently at the moment. When you take a look at CTA positioning in the S&P 500 futures, all right, they're up now. They're becoming buyers again. CTAs have become buyers again. And this is something that could potentially continue to push the market higher. And we've been going over, in a few videos, that end of year rally concept, right? And that end of year seasonality. And now, it seems that CTAs are also looking to be buyers and to catch some of that end of year rally. We'll have to see if that continues, or if the market, starts to cool off a little bit, as it's doing today, before we end up getting the rest of the end of the year rally, if that's going to happen. Financial conditions have eased again amid softer data and the Fed's dovish turn. Now, the Fed wasn't super dovish, but they're really just trying to hold on to a more hawkish tone of voice, and come off more hawkish. But the market's basically calling their bluff. And, we saw treasury yields drop a lot. And we saw the market reacted very well to Powell's speech in the last FOMC meeting. We've had a lot of Fed talk this week, and we're still seeing the market is not necessarily crashing from this, right? So the Fed doesn't seem to have too much of a negative impact on the market these days. They were really happy about what financial conditions were doing. It was doing a lot of the work for them. And if these financial conditions continue to ease again, then that's something that could cause the Fed to come out a little bit more hawkish the next time we hear from them. Now, soft data has southened. Okay, so this is the data for China, US, Euro area, Japan, and UK. All right. And basically, we're just seeing this going down at the moment, especially when you take a look at US and China. All right. We're seeing the data softening here. Okay. US is in black, China is in blue here. You can see the most recent tick has been in the downward direction, also with Japan. And then you have Euro actually tipping up here. Now, these are the US dashboards for the macro matrix. So consumer sentiment is very low right now. Your retail sales year over year is rising currently at the moment. CPI year over year is low. All right. Your average hourly earnings is above CPI. The unemployment rate is still very low. Non-farm payrolls, or I'm sorry, is the unemployment rate is is very low right here, so that's good, okay, for the market. You know, it's has been rising a little bit, but non-farm payrolls right here is also good for the market. It's above 300K on the last one. We have corporate manufacturing ISM, okay, and that's very low right now. That's not a good sign for the economy. Services, PPI, industrial production, those are all low. This is stuff more that the bears are pointing out to you guys, right? The bears are pointing out that, hey, corporates, you know, manufacturing, ISM, PPI, all of these things, they're not strong, okay, and that this could lead into a recession. And you know, it's not a bad theory. I mean, if you think about it, one of the reasons that the Fed would start cutting rates is because something's going really bad in the economy, and if these continue in a downward direction and keep getting lower and lower, and you know, all four of these really get to that very low category, you know, that could really mean some trouble for the economy. When you take a look at housing, existing home sales are basically at rock bottom here. Okay, you can see at the top, this is the rock bottom category. New home sales, all right, are above 5%. We're still seeing, you know, the housing market hold up relatively well. All right. But when you take a look at the housing starts year over year, that's also at rock bottom, and home prices. You know, it says low here, and I wouldn't necessarily agree with that. All right. But on a year over year basis, you know, they're not increasing a lot, right? They're not increasing at a medium to high pace. They're increasing at a lower pace right here. Now, U.S. jobs data, according to Bloomberg, show broad cooling after the run of surprise strength. That's what we're taking a look here on the chart. We have the unemployment rate total in the labor force seasonally adjusted in blue, and then the unemployed and part-time and margin and labor force in yellow right here. Now, as I mentioned earlier, Bloomberg made you know, a very bold call, okay, saying a 52% chance of a 2023 recession. So I don't even know why they would put that out there. I mean, anybody can say if it's 50-50 every single year, either you're going to have one or you're not. I mean, that's not really, I don't even see why they wasted their time putting that out. So just wanted to throw that in there. 52% chance of a recession. We'll see what actually happens. Here's our gold to copper ratio. And, you know, once we get above this level here, this blue dotted line, that's typically once we get into the level of fear. Okay. And you can see that there's been a couple times where there's been a recession, right? The shaded areas here are recessions, you know, right around the early 2000s and then right before the 2010s. Okay. But you know, once we come up to these levels, you know, these have been areas where a lot of times it's been, you know, pretty good buying opportunities, right? Buying in these fear areas right here. And so, you know, the old saying is when there's fear in the streets, you know, when there's blood in the streets, that's typically when you want to buy. When other people are complacent and really greedy and just say, oh, well, everything's just going to keep going up, maybe that's when you want to actually start being a little bit cautious. Now, below are this week's spreadsheets of the long leading, short leading, and coincident readings. Check marks indicate the present reading. If there's been a change in the week, the prior reading is marked with an X. So corporate bonds, negative. 10-year treasury, negative. The 10-year, 2-year spread, negative. The 10-year, 3-month spread, negative. 2-year Fed funds, negative. Mortgage rates, negative. Purchase mortgage applications, negative. Okay. The positives is where we're seeing corporate profits. Okay. The leverage index is negative. We're seeing positives in the credit spread. We're seeing negative in the Miller score. All right. Total commodities is neutral. Industrial commodities is negative. Initial jobless claims was neutral. Gas prices are neutral right now. Oil prices are neutral right now. You know, gas usage is positive right now. And so this is kind of just like a little insight into you know, what's going on in the markets and in the economy as a whole. You know, this is that newsletter. Again, don't forget to sign up for that. All right. You know, use the Ko-Fi page as well. Okay, if you want to book a one-on-one session for me, we'll go ahead and get into the charts here and take a look at TLT and TNX. So we are going to start off with the 10-year treasury first, okay? And the reason being is I want you guys to just notice the trend, okay? The trend is your friend until the trend is broken, right? And we've been in a very strong uptrend in the 10-year treasury basically since March, okay? late March, early April is when we really started this really strong uptrend. And as I mentioned before, it seems like we're topping out with wave five, all right, to complete our wave three, and we're looking for the wave four pullback. We're targeting 4.715. Okay, there was a gap to fill right there. If you notice, we actually gapped down below that, so that's actually now a gap up to fill, and we need to be a little bit cautious of that. We got close to the 4.4 gap area, and we're going to see if we can extend further down to wave four. But ultimately, even if we come down there, that's still just going to be a potential area for it to bounce and continue going back up higher, and looking for it to fill that gap. Now, if we come down here and break that trend, okay, and we get a very clean textbook breakout, retest, and push lower, the next level is going to be 4.128. All right, 4.128 is going to be the next target area to the downside for the 10-year Treasury. And that'll be a sign that it's actually breaking this uptrend, right? If it breaks this uptrend and actually comes down to that level, that's going to be pretty important to watch and pay attention to. It's still well above its 200-day moving average. If it was to come down to that 4.128 area, that would get a little bit closer to the 200-day moving average, and that can be another area of support potentially for yields to go higher. Remember, as yields go higher, okay, things like TLT are going to go lower, right? And so when you take a look at TLT, the last time we were watching and being cautious of a potential bear flag here, we can see that bear flag did not play out. And we've actually had a very strong rally as we've seen yields come down, right? So we just saw how we are getting that wave four pullback in the 10-year Treasury yield, right? And as we're getting a pullback in yields are going lower. We're seeing things like TLT go higher. But ultimately, I've mentioned that we have this range here about 89.21 down to 82, all right, for now. That's really where I think we have the possibility of consolidating until we have a much clearer picture, right? Until the picture is actually at the end of the day, there's a lot of speculation about what the Fed is going to do with rates. There's plenty of people saying that they're going to do one more rate hike, plenty of people saying they're pausing, and then there's lots of people saying they're actually about to start cutting soon. And it's not up to us to really know, but to try to use all of the data available to help give ourselves an advantage and formulate our own opinions. So if the 10-year Treasury wave four down is complete and it's about to start going back up again, TLT has two gaps down to fill, right? And that'll be really interesting to see. Okay, especially with this gap here, right above $80, essentially, or $85. That's going to be really interesting because if we do pull back and fill that gap, it's actually not the end of the world, right? We talked about it in the beginning. That could actually form an inverse head and shoulders here if we come down to that 85 area. And then you would look for essentially a break of the neckline would be something like this. Let me get a straight line for you guys real quick. So essentially this would be your neckline here. Okay, and you would be looking to target some type of move like this here, right, where we pull back to that gap fill, we break through that neckline. Okay, so we get a break, retest, push higher, and we fill this gap up here, we fill this gap right here, and potentially if we can get above 94.74, there's another gap up here to fill above 96, and another one here just above 97. So there's lots of upside potential in TLT, but you just have to manage your risk and look at things from an unbiased view, right? You don't want to be overly bearish, you don't want to be overly bullish, and that's why I kind of mentioned it really wouldn't surprise me now if we start to flip 89.21 to support from resistance, right? If we can do that, that's going to be a good bullish outlook for me. That's going to say that, hey, TLT put in a bottom here, and now we're ultimately going to be looking to see if 89.21 can be the new higher low. Because for now, the trend has just been lows and lower lows, and we're continuing to put lower lows in, and we're continuing to put highs and lower highs in. So, until we can start to, put some lows and put some higher lows in and put some higher highs in, that's what we're going to be looking for as a sign in a shift in the narrative of TLT. But for now, TLT's just been continuing to make lower highs and lower lows. Same thing with the 10-year Treasury. It's been continuing to make higher highs and higher lows. So, the trend is your friend until that trend is broken. And as of now, yields are continuing their bullish trend, even though they're in a pullback currently at the moment. All right. And the TLT is continuing its downtrend, even though it's having a bounce here as of recently. Okay. So, That's pretty much it for today's video. Don't forget to smash that button, smash that like button, subscribe to the channel if you guys are new. Join the Discord, okay? There's a link in the description to join the Discord. I'll be in there active pretty much every day almost, unless I have something going on. And you'll be able to see, all of the different trade ideas, get first access to the trade ideas before they're published in the newsletter. The newsletter is completely free. So, if you don't want to pay a couple bucks a week, you can just sign up for the newsletter, and I'll still be pumping out really good content in there as well.